So welcome back to another Advance Your Wealth episode with Homer Smith. I am your host and moderator today, Eric Daniels, a wealth advisor on the Convergent team. Today we have an exciting market update for you. We'll first be covering November's historic month, looking at 2024, and wrapping up with higher interest rates and who is really being hurt the most. So with that, I'm happy to welcome our special guest, Joseph Sikora, Chartered Financial Analyst with Aptus Capital Advisors. So Joseph, let's first look at November. Both equity and bond markets had a historic month. Give us some insights into what was really driving those moves.
Yeah, sure. Thanks, Eric. So as in a lot of the moves that we've seen in equity markets over the last few years, in large part, those moves have been dictated by what's happening in interest rate markets. If you think about coming out of October, the 10-year Treasury yield hit a yield of around 5%. And then starting at the end of the month and then into November, you saw rates drop precipitously. And that led to large gains in equity markets. And you really had two dynamics, I would say, in play in November. One was this reemergence of the idea of a Fed pivot. And what I mean by that is that instead of continuing to increase interest rates or hold interest rates higher, the idea that the Fed's going to turn and actually start to cut interest rates on the front end of the curve. So that was one thing that served as a catalyst for equities. And the second was a loosening of financial conditions, which served to increase liquidity in the market. So you saw a situation where the New York Fed's reverse repo facility was being drawn down and pulling liquidity into the market. And anytime you see that, typically those flows find their way into risk assets and serve as sort of a buoy to those type of markets. So anytime you're getting lower interest rates, tighter credit spreads, this increase in liquidity typically serves to benefit risk assets. And that's what we saw in the month of November in a big way.
And so when we look at how the market's positioned right now, it seems like everybody is Fed pivot, Fed pivot, right? So what would derail that and push and actually cause some risk to the downside in the equity markets?
Yeah, sure. So if there's one thing we've seen over the last 2 years is that the same movie's played out several times. In fact, we can go back and count 7 different times where the market presumably has priced in some sort of Fed move in Fed policy, what we're calling a Fed pivot. So maybe the 7 times the charm, but the fact of the matter is they've been pretty persistent with the idea that they're going to hold rates higher for longer. And so far they've done that. They've done that even more than they thought that they would. Their messaging really hasn't changed a whole lot there. Why people think the 7th time is different is that inflation has come down meaningfully. And you've seen a little bit of underlying unrest in some of the different macroeconomic data. So it gives market participants the belief that the Fed's going to have cover to start cutting rates. So what would be essentially turn from a tailwind to a headwind for markets would be if inflation continues to hold in higher, if it doesn't continue to see this downward turn, if you see the economic data, especially employment, and we get Friday, tomorrow, the 8th being the non-farm payroll day, you see that data come back continuing strong, then you create a situation where the Fed really doesn't have a lot of clearance to cut. So I think that would be potentially another situation where almost bad news is good news and good news is bad news in terms of how the market interprets what interest rates are doing.
Yeah, as investors, we have to turn it upside down. Bad news is good news at the moment until it's not. So thank you for that. So I guess now shifting to 2024, I guess what is 2024 telling us from a holistic perspective, and then how can we interpret today's equity valuations?
Yeah, sure. So if you look at 2023, we still have 4Q to go in terms of earnings, but it's going to be roughly a year-over-year flat period in earnings is where it looks like it's going to come in at. $220 on the S&P 500 is the expected earnings for 2023. It was $219 for 2022. If you look ahead to 2024, though, and then even to 2025, that's actually out as well in terms of expectations. we're looking at back-to-back years of expected roughly 11% year-over-year earnings growth. That's big. That's a larger CAGR than we've seen historically in the market. And it's in the face of a situation where interest rates, as we just discussed, are much higher than they've been over the last 15 years. So you could say there's a good bit of optimism in the market. And those estimates actually have come down from where they were over the last 6 or 12 months. But in the last several months here, they've actually flattened out and begin to tick higher again. In the month of November, they ticked about $1 higher for next year's estimates. And you could say potentially that's attributed to the fall in interest rates and what that's going to do for corporate balance sheets. But I think at the end of the day, you have to say that there's a decent amount of optimism priced into the market. Some have kind of said this idea of a soft landing that the Fed's trying to pull off is to some degree priced into the market. And we can see that in valuations as well. If you look at S&P 500 growth and value indices, both of those are trading at pretty strong premiums to where they have over recent history. And a lot of people look at growth and kind of what's driven the market this year and say, well, growth is the one that's really out of bounds. And when you look at it, you actually see that if you look at forward valuations on the value index, they're actually higher compared to recent history than where growth is. Now, growth on an absolute basis trades at a higher multiple than value, but relative to where they have historically, growth actually is in a less elevated position than where value is. And that can be attributed to the fact that earnings on the growth side have been really strong, aided in part by the strength at the mega cap names. And this year we've been talking about the term that the market's given to the top 7 names, the Magnificent Seven. The market returns in those names has been extraordinary this year, nearly double year to date. You think that is kind of getting away from itself, but when you look at the earnings expansions that they've had and what's expected into 2024, you see that to some degree those moves are pretty warranted. So I think we're in an environment where optimism's high. That's reflected in the valuations, and we just have to see if the actual incoming earnings and economic data support what's a pretty favorable outlook.
Yeah, and so part of that optimism, I'm sure we've all heard, is the hype around AI and what that could potentially do to productivity. Do you think that is years away? Do you think it's here? Do you think that is a secular growth story? Do you have any opinions on that?
Yeah, sure. So, and we're recording this on the 7th today. Google just came out this morning with kind of updates to their AI technology. The stock's up, or at least earlier, is up 5 or 6% on that news. So we're seeing big market moves based on this technology, just like you said. And I think there's 2 ways to look at this. Years ago, everyone thought kind of blockchain was going to be this new technology that was going to kind of revolutionize a lot of how we do things and how the world works. And so far, you could argue maybe that hasn't materialized. But at the same time, you can look at the flip side and say, if you look at the early applications of how AI is being used, it is leading to massive productivity gains where it has been effective. And where we've seen productivity gains, we've seen increases in corporate margins and therefore higher earnings, which obviously have a huge correlation with market returns. So you can create, I think, an argument either way on that. I tend to lean on the idea that AI is definitely real. It's not new, for one thing. It's been around. It's just continuing to grow in its application and its use cases. It's going to continue to do that. It's going to have a big impact on our lives and on corporations. It's just how much of that is being front run right now in valuations, how much that's being front run in kind of optimism and what's being priced in the markets. And I think that's, as a stock picker, as an investor, that's always the kind of balance you're entering in is what's kind of the quality of the idea or the company or of whatever you're investing in, and then what am I paying for that, and trying to balance those 2 ideas.
Right. So, and then also looking out in 2024, we're coming into an election year. There's a lot of headlines around government spending, potential shutdowns, kind of continually kicking that can down the road. I guess and then also in the face of geopolitical unrest and issues geopolitically. So I guess just give us some insight into what an election year looks like with these a potential debt crisis and then also geopolitical issues out there.
Yeah, I feel like the present time is always considered, in some sort of superlative, the most this, the most that. You can always point to some point, you know, in the present where you say we've just got more than we've ever had, or whatever the case may be. And you can make that argument now. 2023 is going to witness a year where the government deficit outside of a war year was the largest percent of GDP that it's ever been. So you kind of think, why are we spending the way that we are without any kind of imminent threats to our safety, or a pandemic, or whatever the case may be? But that's kind of where we find ourselves. I think the thing is, though, is that when you find yourself in an election year, even if there potentially is a need and there's some cause for austerity at the spending level, you're probably not going to get that, because the party in control wants to stay in control, and they're not going to do that by cutting spending and making a lot of people unhappy in that regard. So that can probably get kicked down the road. And in terms of deficits and that sort of thing, they're only going to be kind of fuel on the fire by the geopolitical instability that we have out there. You see at least decent kind of agreement on the fact that a lot of our allies globally, we need to support. Not everyone's on board with that, but for the most part, that's being supported in Washington, which is increasing spending. Of course, you still have entitlements, which are, being, again, kicked down the road there. So we're probably going to see a big deficit again this coming year. Will that be addressed in the next election cycle? Potentially, but it won't be addressed beforehand.
Yeah, and then historically, is there more volatility coming into the months leading up to the election when the market's trying to price in policies one way or the other? Is that typically the case?
Yeah. So if you look back historically, we've seen decent market returns in election years. I think for all kind of the headline risks that you run, you've seen relatively good performance based on historical averages. And I think that goes to the point that we just talked about, which is that governments in control are trying to stay in control, and they're going to do whatever they can within their power to not disrupt that. And let's face it, the fiscal spending, the U.S. government swings a big stick and can do a lot, not to directly manipulate markets, of course, but to continue spending and doing the sort of things that markets like to see, that companies like to see, that consumers like to see. So I think when you kind of think of that dynamic, it creates a situation where typically markets are supported in election years because of that. Now, that doesn't mean some sort of exogenous impact, whether it be on the corporate earnings side, what the Fed's doing, with where their interest rates, geopolitical. It doesn't mean anything like that can't derail it. It just means absent some sort of move like that, you probably have a situation where you do have somewhat more muted volatility, and then probably decent returns.
All right. And so kind of wrapping up, I wanted to lastly look at what the Fed has been doing basically for almost 2 years now, 18 months to 2 years, tightening financial conditions, raising interest rates. Give us some insight into who is really being hurt the most by that. And yeah, I guess just who's really being hurt the most by higher interest rates.
Yeah, sure. So, interest rates are obviously much higher than they have been over the last 15 years or so. If you think about getting a mortgage now, it's above 7%, whereas during COVID, it dropped to 3% or below. Over the last decade, mortgage rates have, hovered around 4% or somewhere in that area. So you're talking about substantially more penalizing borrowing costs. At the corporate level, you've seen that as well. I think what is different and who it's having an impact on and who it's not is who is being forced to reprice debt into those type of environments. So if you think about consumers, think about mortgage holders, they did a fantastic job of refinancing at record low rates. So if you think about a mortgage right now is above 7%, but the weighted average U.S. mortgage rate is somewhere in that 4% or below range. So you're talking about nearly half. of what the effective mortgage rate is versus where current mortgage rates are. That's part of also why we're seeing this effect that no one's wanting to sell their house right now, because it's not that they don't want to sell their house. They don't want to sell that really attractive mortgage rate that they have. We also saw this at the large cap level. When you think about the largest companies in the world that did a great job of refinancing during COVID at extremely low interest rates with very long fixed rate terms. So you think about rising interest rates. If you have large cash balances as a corporation and you have fixed rate debt at very attractive rates, rising interest rates not only maybe doesn't hurt you, it might actually help you, because cash on your balance sheet might be getting 5% and you've termed out debt at really attractive interest rates, in some cases below that amount. Where we've seen the biggest impact is entities, companies, individuals, whatever, that are being forced to refinance debt into these higher rate environments. And where that's being impactful the most is at kind of the small cap level. And that's part of why you've seen this dynamic this year where large caps have vastly outperformed small cap stocks. But if you look at just the Russell 2000 as kind of a proxy for small caps, next year is pretty muted. In 2025 actually is fairly muted, but you get into 2026 and 27 and 28, in the neighborhood of 20% of the index debt in the Russell 2000 reprices over those 3 years, whereas at the S&P 500 level, it's less than 10% a year there. So you're talking about substantial refinance risk for companies that are lower credit quality and therefore have to pay higher interest rates anyway. And this is having a negative impact on sentiment. So if you look at like small business optimism, the surveys that go out, they've been kind of teetering around lows here for the last 12 months. And part of that's been because of rising employment costs. It just costs more to hire people and they're having a hard time doing it. A lot of it has to do with interest rates and how it's repricing their debt or their lack of availability of getting credit at all. So why this is concerning is that if you look at employment as a percentage of total employment in the U.S., small businesses, so those companies that hire 50 or less people, employ 45% of Americans. So if you think about your largest corporations, the ones that hire over 500 people, that's only 16% of hiring. So even though we're talking about many, many, many different entities, this squeezing effect could potentially have a bigger impact on employment than what we see at kind of the big corporation level. And if that happens, that could end up having ripple effects through the market at large. So these are things we're watching pretty closely. And the fact of the matter is, at some point, you just can't raise interest rates how we have and not have some sort of effect happen. It really hasn't happened too bad yet. So, keeping an eye on it to see if that changes.
Yeah, and so we did kind of see some cracks at the beginning with the banking crisis. Do you think that that's over, or what are some other potential risks out there with higher interest rates? So I know that we have a wall of debt on the small cap side that needs to get repriced. And is that going to cause a tick up in bankruptcies? Is that going to cause a flurry of M&A activity? What do you think? What do you think's the kind of outcome there?
Yeah, so sure. What we saw with the banking crisis is that the Fed was more than willing to step in and provide liquidity there. And that really shored up markets big time. It really showed that, hey, banks with this type of collateral are going to have ability to service their obligations. And that, I think, went a long way to instilling some confidence in the system, in a large part to why we haven't seen some sort of systemic type of moves coming out of that. But in terms of what other impact, interest rates would have, I think that's why the market is so fixated on this soft landing idea in the pivot in rates, because they know that if interest rates do stay where they are now or go higher for a very, very long period of time, something will eventually break. And I think the market is hopeful that because of what we see in the drop in interest rates, the Fed's going to have the clearance to be able to cut interest rates and then avoid that type of scenario. So it's safe to say that some sort of what they call hard landing is not priced into equity markets because of optimism around interest rate cuts. It's also safe to assume that if you never do kind of find clearance to eventually cut rates, something will show itself. It's kind of by definition impossible to know, because if you knew, you could get out in front of it. A surprise will, again, by definition, not be so much foreseen, at least by by the masses, but you can rest assured, and there's been examples through history of how this has manifested itself, but you can kind of be rest assured something's going to not like it. So again, market really fixed on this idea that that's not going to happen.
Yeah, kind of like how everybody thought that there was going to be a recession, and then there was no recession. We still could see that down the road, but everybody was priced that way, and now everybody's priced that the other way so quickly. Even just
that's a good point.
in a month span.
Something we've talked about on the show before too, is that sometimes positioning can be self-fulfilling. So, if you have everyone positioned for a recession and a subsequent drop in equity prices, you almost can't have a drop in equity prices because everyone's already positioned accordingly. Same thing happens on the upside. You essentially get your last buyer of equities in there. There's no one left to support the market. Now we're a long way from there right now, but we've gone a long way in the last 12 months from a positioning and sentiment standpoint to where you could say sentiment positioning was really a really big bullish indicator a year ago, and now it's probably neutral to slightly bearish. You have so many people thinking of one outcome is going to happen. It creates a situation where it's tough for that to at least advance itself in how future returns play out.
Yeah. All right. Well, Joseph, I want to thank you so much for taking the time with us today. Your insight, your expertise, your analysis is it's unparalleled. So I want to thank you for that. And so if any of the viewers today have any questions regarding what we talked about today, there will be a link down below. Feel free to reach out directly and we can get those answered for you. So Joseph, with that, thank you so much. Appreciate your time, and we look forward to the next one.
Yeah, my pleasure. Thanks, Eric.
Thank you.